Hello everyone, today we'll be talking about a stock that I think is an amazing company trading at a fair value. What Warren Buffett calls the best way to invest, buying wonderful companies or businesses at fair valuations rather than a fair company at a wonderful price. And this particular stock is of the highest quality, has low margins and is being hit a lot by uncertainty and market volatility at the moment. Then we're going to be focusing on valuation. So I'll be comparing this to similar companies and be looking at their historical metrics in terms of free cash flow, operating cash flow and price to earnings before discussing and performing a discounted cash flow analysis of this company to come to a fair value right now. So if you get something out of this video and want to see more just like it, then feel free to subscribe to the channel and maybe consider giving the video a like. So let's look at the business that I think is offering probably the best risk and reward relationship right now. The highest quality company that's trading for a fair value to undervalued price and is currently probably the best sort of opportunity given the market sort of volatility and the sort of high prices we are seeing right now. And that price is for Google. Now, I've recently doubled my position in Google based off similar findings that I've found through analysis. I now have 23 shares over £3,000 and my cost per basis is around $160 per share. But I actually bought into this one when it was sitting around about $150 per share and have since bought more. My main reason is because now it sits at $169 per share, and I think this offers a very good opportunity with the current situation we're seeing in the market. We are seeing historical highs and very high price to free cash flows, operating cash flows and the like of price to earnings. So when I see those sorts of things, I try to have to look a bit harder into companies I want to buy into. And this now currently takes my weighting of Google to around about 6%, which is quite nice and something I want to build on with time. As I say though, this is my own analysis and of course my own money. So please do your own research before buying into a company just because a random guy like me on the internet thinks it's a good time to buy. Now, there's a lot of speculation in the market right now that the Google is going to be broken up and that the DOJ will make them sell aspects of their business, the latest one being to sell Chrome. To this, I would probably say that this is the reason we are seeing this stock trade down around to fair to undervaluation right now, is because people are being fearful and they don't see the opportunity that I do with the likes of this company. Now, Google have tried to defend themselves and defend this staggering proposal that they have offered up by the DOJ to sell Chrome. And to me, I think it would hurt the American consumer a lot more than really would be practical in a judge's mindset. So I think it's unlikely to happen. And I see every time that DOJ offers up a new statement for how they're going to break up Google and Google's share price goes down, I see it as a bit of an opportunity right now in this high value market. Now, that being said, Google is bringing record highs of revenue. As we can see here, their search advertising business is their main revenue stream, hence why the DOJ's attempts to break it up or at least affect it is causing investors such worries. But in this particular quarter, we can see their search advertising business in Q1 of 2024 brought in around 57.3% of their revenue stream, or around 46 billion. And then we've got YouTube ads bringing in about 8.1 billion, or 10%, and Google's ad network bringing in 7.4 billion, or 9.2%. All of this being ad revenue stream. And that is effectively making Google the ad revenue king, bringing in massive amounts well above the likes of Meta and other companies. Then we've got the other aspects of their revenue, which effectively are not ad-based. We've got Google subscriptions, platforms and devices, the likes of Android and Pixel. That offers about 10.9% or 11% of the revenue stream at $8.7 billion. And then we've got Google Cloud, which is effectively the cloud offering that Google offers. Around 12% of revenue comes from there, or about $9.6 billion, bringing the total revenue stream for Q1 of 2024 to around $80.5 billion. So that's plenty of money brought in mainly by ad revenue. And now we have to see what areas of these profits are growing and how fast. So last quarter in September 2024, they had a revenue stream of around $88 billion. And that was up from 2023's third quarter of around $76 billion, which is about a 15% change in revenues year over year. When it comes to which aspects are growing fastest and producing this 15% revenue growth year over year, we have some obvious winners. We've got Google Search and Ads revenue, which grew by about 11% last quarter to $49 billion year over year. And the same growth rate for YouTube Ads was seen in revenue to around $8.9 billion from $7.9 billion last year. Google's network has effectively stayed flat to down, so no growth there. And then we have subscription and services growing at an impressive 22% to over 10 billion last quarter. And that's obviously followed by an amazing growth in Google Cloud of 35%, which is actually the fastest amongst all the cloud giants like Amazon, Microsoft, Azure, and of course Google is the fastest growing amongst them all. To me, the areas that are offering the most opportunities for growth with Google are the Google Cloud service and of course Google subscriptions, platforms and devices, which are growing at quicker rates than the other forms of Google's business that are all ads based. So over time, they may become less reliant on ads than they already are right now. Let's get on to the thing that matters right now, which is Google's valuation. Now, what I like to look at usually is free cash flow. But just now I want to touch on price to earnings for Google because it actually looks very attractive right now. If we take a look at the 10-year average of price to earnings for Google, we see that it currently sits to a price to earnings ratio of 22, which is well below the average or the median that we are seeing for this company at 27 to 28 times. So at the moment, it's trading for a discount and undervaluation based off just looking at this metric. And if we wanted to compare that to other companies that we might be looking to add, tech-based companies that are in the Magnificent Seven, the likes of Meta, Apple, Amazon, and obviously Microsoft, there is obvious undervaluation just by this metric. We have other price to earnings all trading a lot higher than Google's. Google sitting the lowest at 22 times, Meta seeing next lowest the 26 times price to earnings. Then we've got the likes of Microsoft at 34 times, Apple at 38 times, and Amazon coming in at 43 times. Now this doesn't tell us that this price is very attractive, but it does show in relation to its peers and the other options in the market that we may be looking at in the Magnificent Seven, it is trading at a good valuation just looking at earnings. And of course we hit a bit of a snag because Google is effectively not looking so good in free cash flow right now. If we take a look at Google's price to free cash flow ratio right now, it currently sits at a very high average of 37, a lot higher than the average over the past 10 years or the median that sits closer to about 29 times. So to me, it doesn't look as good on the free cash flow side of things, and it looks very good on the price to earnings side of things. If we compare the two, we can see an obvious, effectively almost comical difference. They're effectively so far apart when normally they are always sitting very close together, and sometimes we see the PE shoot up well above what effectively the free cash flow is. What is happening right now is effectively the free cash flow is not looking as good as the earnings because of the obvious capex expenditure related to AI. Google is spending a lot of money in trying to bulk out its service and offer more and more services in relation to AI. And this is very expensive for the likes of NVIDIA chips being bought by the likes of Google, Microsoft and Amazon. So all the big tech companies are doing this, and effectively this is skewing Google's price to free cash flow considerably. So I don't think it's the best metric to use for this company. We have two different historical metrics there. We've got one that's quite favourable towards Google and one that is against Google. But if we take a look at the operating cash flow, we can try to help Google out in terms of being quite a bit more fair. We don't want to take their current price to free cash flow because that is a lot higher than the norm. So if we use operating cash flow to do a DCF valuation, we can try to get a fair value for this company. And if we say they're going to grow their operating cash flow at about 11.5%, which is a conservative amount and a lot lower than their 5-year average, we say they're going to buy back their shares at a similar rate to how they've done in the past 5 years at 2.32%. And they're probably going to grow their dividend growth rate at a 15% CAGR, which it can happen. Their payout ratio allows for it, but it's whether Google decides that is what they want to do. And then we just lower the average price to operating cash flow to around 17, just to predict a little bit less than the 17.27 operating cash flow over the past 5 years. Then we get a fair value in this stock and share price of $178.99, which is around a CAGR of about 11%, which is still a market-beating return for Google. And to me, this is still a good valuation. We're currently seeing around $169 per share, and I think that's a good price for the likes of Google. You're getting a fair valuation, and it's still above the market-beating returns that we like to do with individual stocks. But that's just my opinion. I think Google is trading at a good valuation right now, whether you look at their price to earnings, which are more favourable, or if you look at their price to operating cash flow, which is, I think, a bit more of a fair metric. And price to free cash flow, I think, just simply doesn't really offer that much in terms of analysis for Google at the moment. But tell me what you guys think. Do you like this sort of one? Obviously I do. I've doubled my position, but you don't have to agree with me. Thanks for watching. I do appreciate it, and I'll catch you in the next one.